there's always caution around this, and as you know, Tom, we don't offer it. We do provide the opportunity for some of the ETF vehicles to be purchased or sold, but it's always with a wrapper around about understanding the risk associated with this. It's not a currency. It doesn't really provide and hasn't provided an inflation hedge per se, and that you have to treat it like a very speculative trade or investment in your portfolio. But beyond that, we can't control what all of our investors want to do. But I'm a skeptic,
and I am
just on crypto in general.
Paul, I'm going to get in trouble here, but I'm upset every time I go to the Bloomberg and do the symbol for Bitcoin that we have, which is XBT, X-Ray Boy Tom, and I have to hit the famous yellow currency button.
Yes, you do.
Next, it's not. I don't care where they put it.
Yep.
But it's not. I think it's more like an equity almost. But continue.
We'll talk.
It's not. Liz Ann's right. Folks.
I know a guy on the 6th floor we can talk to about that.
Yeah, work on that.
Hey, Liz Ann.
It's become very correlated to indexes like the NASDAQ 100. So I think you're absolutely right.
Hey, Liz Ann, we're just kind of through the earnings season here. A couple more of the retailers left to come here. What's your takeaway?
Maybe yet again, but to a more significant degree, you saw analysts forced to lower the bar to a more significant degree than was actually necessary. And as a result, you've had almost a perfect round trip. If you go back to October of last year, the expectation was about 11% earnings growth for the fourth quarter. You started the reporting season down sub 2%. But then you've seen analysts have to ratchet things back up. And last I looked yesterday or Friday, it was back up in the 10% and change. Now, in fairness, though, because of the way base effects work, that increase that we're now seeing in Q4 2023, because the bar gets set too low, you've seen analysts have to ratchet down estimates for Q4 2024 because the year over year is not going to be robust because you got that bigger pop in Q3. But I think analysts have been admittedly flying a little more blind in this environment called the pandemic era, where even though there's fewer companies that are not providing guidance at all, the guidance is just not quite as, maybe it was never precise, but the guidance is a little more loosey-goosey right now, leaving analysts to have to kind of finagle things on their own and also not adjust earnings too far out.
So one of the things, Liz Ann, as people try to get a handle on those earnings is we need to see a broadening out of this market. We saw a little bit of it in November, December last year, but it still feels like this market may be a little too thin in terms of maybe the Magnificent 7 or 5 or however many are left are kind of really driving the performance here. And a lot of folks say that makes them nervous. How do you think about it?
So I do think there still is risk associated with the concentration, but it's nowhere near as acute as it was last year. To your point, that we've had to start whittling down from the Magnificent 7 to the sensational 6 to the fabulous 5, because we've seen that move from, in the case of Tesla, just out of the 7 in terms of the largest 7 stocks, recently dropped down to number 10, and you've had stocks outside of the sort of techie world like Berkshire Hathaway, like Eli Lilly, leapfrog Tesla. But I think what's happening, and you don't pick it up necessarily by traditional breadth statistics or just looking at the Mag 7, is there's more churn under the surface. So the NASDAQ index overall, at the index level, the maximum drawdown this year from a year-to-date high is only 3%. But the average member maximum drawdown, again, year-to-date from a year-to-date high within the NASDAQ is negative 22%. So there's a lot more churn going on under the surface. And I think in this kind of market environment, to get the true story, the narrative that the market is telling, you have got to leave aside just index level analysis.
Liz Ann, 4 equity types in a room, you're going to get 17 answers on a rebalance. What is the Liz Ann Sonders formula for rebalancing?
So I think to the extent investors can do it based on the implications of turnover, tax bracket, et cetera, I think portfolio-based rebalancing versus calendar-based rebalancing, letting actual moves in your portfolio, whether it's at the individual stock level or some group like the Magnificent 7 or at the sector asset class level, let the moves up and down as a share of your portfolio dictate the timing associated with rebalancing versus, say, what the mutual fund complex does, which is last week of every quarter. It's very calendar based. And I think that's just a beneficial way for individual investors to stay in gear, not have to make all or nothing decisions. And as I always say, do a version of buy low, sell high, which is, add low, trim high. And it's, I suppose, boring to talk about. I love when you guys ask me about that. But for the most part, it's not the bombast that is more intriguing to people, but it's actually what matters.